For over 110 years, the Federal Reserve, or simply known as the Fed, has been a cornerstone of the American financial landscape. Yet for most Americans, it remains shrouded in mystery. You've heard its name, but does everyone really understand the power it yields? Picture this, a central bank so influential, it could be considered the puppeteer of the global economy. So what exactly is the Federal Reserve? It's not just one entity, but it is made up of three entities. The Federal Reserve Board of Governors, perched in Washington, D.C., 12 regional banks scattered across the nation, and the Federal Open Market Committee, where 12 members hold the reins of monetary policy. The Fed's mission? They have 5 functions. They set the nation's monetary policy to promote maximum employment, stable prices, and moderate long-term interest rates in the U.S. economy. Promote stability of the financial system and minimize the systemic risk. It provides financial services to the U.S. government, regulates banking institutions, and safeguarding consumer credit rights. And the Fed acts as a lender of last resort to financial institutions. When this fails, we get bank bailouts. And as G. Edward Griffin describes in his famous book, The Creature from Jekyll Island, the name of the game is bailout. The objective of this game is to shift the inevitable losses from the owners of the larger banks to the taxpayers. Born from the Federal Reserve Act of 1913, the Fed has evolved with several amendments, with a pivotal moment in 1977 when it was tasked with the dual mandate of maximum employment and price stability. This was in the wake of 1971 when President Richard Nixon severed the dollar's last link to gold, ushering in a new era of economic strategy. Looking back over a century, one might question the Fed's success. Has it truly fulfilled its grand purpose? Why does a central bank hold such sway over not just America, but the world? And why does the US even need one? Let's embark on a journey through the tumultuous history of banking in America, leading us to the very doorstep of the Federal Reserve Act of 1913. Strap in as we unravel the threads of economic power, policy, and politics that have shaped our financial reality. I'm Ryan Sahlberg, a retired Marine Corps infantry officer and combat veteran with service in both Afghanistan and Iraq. My passion for history has driven me to study it for decades, starting at the Citadel when I graduated with a BA in history, and that journey continues to this day. To grasp why we have a Federal Reserve in the United States, we need to delve into our nation's banking history. Let's start with the Revolutionary War against Great Britain, where the Continental Congress faced the challenge of war financing. They turned to issuing paper money, spearheaded by Governor Morse, one of the founding fathers and member of the Continental Congress. From 1775, they ramped up the printing of fiat currency. Before the war, the money supply was around $12 million. But between 1775 and 1779, Congress expanded this by an additional $225 million. This surge led to a rampant inflation and a sharp decline in the value of paper notes compared to hard currency like gold and silver. By 1781, the Continental had become nearly valueless, giving rise to the phrase "not worth a Continental," symbolizing the currency's dramatic depreciation. In 1781, the Continental Congress appointed Robert Morris to manage the national finances. By spring, he proposed the creation of the first central bank in the young republic, the Bank of North America. This institution was to be a privately owned central bank, akin to the Bank of England, operating on a fractional reserve basis. Its currency was to be backed by specie, yet it was designed to allow for controlled inflation to expand money and credit beyond the actual gold and silver reserves. The Bank of North America began operations in 1782. It was granted the unique privilege of having its notes accepted at par with specie from all government taxes and duties, and it had an exclusive right to issue paper currency, creating a monopoly. In return, it primarily lent money to the federal government to buy public debt, with taxpayers ultimately responsible for repayment. However, soon after opening, the bank's notes started to inflate relative to specie, leading to a loss of public trust. Outside of Philadelphia, where the bank was headquartered, these notes depreciated significantly. As Robert Morris' influence waned, he transformed the Bank of North America from a national institution to a state-chartered commercial bank in Pennsylvania. By the end of 1783, the federal government had divested all its shares, which was 5/8 of the bank's capital, and cleared all its debts to the bank, marking the end of the United States' initial foray into central banking. An interesting footnote in this saga: the Bank of North America eventually evolved into the First Pennsylvania Bank of Philadelphia, which, as the oldest bank in the nation, faced financial distress and was bailed out by the FDIC in 1980. Fast forward to 1789, a pivotal year in American history. The ratification of the U.S. Constitution ushered in a new era, bolstering the central government's power beyond what was seen under the Articles of Confederation. Amid this transformation, President George Washington took office, setting the stage for a political rivalry that would shape the nation's future. Enter Alexander Hamilton, a disciple of Robert Morris and a dynamic and visionary figure. He dreamed of America with a robust central government, reminiscent of Britain's, led by an elite class. Appointed as the Secretary of Treasury, Hamilton was a proponent of a national bank, believing that a manageable national debt could fortify the country's credit standing. On the flip side, Thomas Jefferson, equally brilliant but with a contrasting vision, saw America thriving as an agrarian republic, with power diffused among the populace, not concentrated in financial institutions. Washington appointed him Secretary of State, and from this position, Jefferson vehemently opposed Hamilton's financial plans, particularly the idea of a central bank, which he feared would favor the wealthy at the expense of the common farmer. In December 1790, Hamilton presented his blueprint for a national bank to Congress, inspired heavily by the Bank of England. He envisioned this bank as a cornerstone of national finance, managing government funds, facilitating the collection of taxes, and managing federal debt, essentially acting as the financial backbone of the burgeoning nation. Jefferson, however, saw this as a dangerous consolidation of power, potentially sidelining state banks and skewing economic benefits towards the urban elite, leaving rural America at a disadvantage. This debate over the national bank wasn't just economic, it was a battle for the heart of American democracy, setting the stage for ongoing political and economic discourse that would echo through the centuries. In early 1791, the air in Congress was thick with debate as the bank bill came to a vote. It passed, but the real drama was yet to unfold. The bill now sat on President Washington's desk, awaiting his signature or veto. Enter Thomas Jefferson, with his pen mightier than any sword, crafting an urgent plea for Washington to reject the bill. His document, titled Opinion on the Constitutionality of the Bill for Establishing a National Bank, argued passionately that the Constitution did not explicitly grant the federal government the power to create such an entity. Jefferson zeroed in on the phrase, necessary and proper, insisting that convenience for tax collection did not equate to necessity. Washington, caught in the crossfire, gave Alexander Hamilton a week to counter Jefferson's arguments. Hamilton, never one to shy away from a challenge, unleashed a 15,000-word rebuttal. His take? If the Constitution didn't explicitly forbid a national bank, then establishing one was well within its bounds. This wasn't just a battle of words, it was a clash of visions for America's future. Jefferson pointed out that the Constitutional Convention had debated and dismissed the need for a national bank, underscoring his point that it wasn't essential. However, it was Hamilton's interpretation that swayed Washington, leading to the bill's signing into law in February 1791. Thus, the first Bank of the United States was born, with a charter set to last 20 years. This decision, as economist Murray Rothbard noted, set a precedent for an expansive interpretation of federal power, suggesting that the Constitution could be read to, quote, imply, end quote, powers for achieving national objectives, a view that would gain legal traction in 1819 with the Supreme Court's ruling in McCulloch v. Maryland. The signing of the bank bill wasn't just the creation of a financial institution. It was a pivotal moment that defined the trajectory of American governance and economic policy that would lead to a battle over a national bank for over the next 4 decades. The first Bank of the United States was modeled after the Bank of North America. Thomas Willing, a close ally of Robert Morris and former president of the Bank of North America, was made president of the newly established central bank. Launched with a staggering $10 million in capital, of which the U.S. government held $2 million, it quickly became the nation's financial powerhouse and the largest corporation of its time. The sale of its shares was not just a financial event, but a spectacle, marking the country's largest IPO up to that point. However, the twist in the tale was the significant foreign investment, which, while legally powerless in voting, raised eyebrows and whispers among the American populace about external influence in domestic affairs. The bank's role was multifaceted. It served as the federal government's fiscal agent, managing everything from tax collections to government loans, deposits, and bill payments. Despite the government's stake, it didn't directly run the bank but enjoyed a share of its profits, blending public oversight with private enterprise. Operating also as a commercial bank, its paper currency, or banknotes, entered the economy primarily through lending, a stark contrast to modern central banks like the Federal Reserve, which set monetary policy and act as a lender of last resort. This institution, though lacking the regulatory powers of today's Federal Reserve, helped shape the financial landscape of early America, setting the stage for the complex interplay between government and banking that continues to evolve. The first bank of the United States quickly inflated the money. From 1791 to 1796, wholesale prices soared, with the index jumping from 85 to a staggering 146, a 72% surge in just half a decade. This wasn't just inflation, it was a financial revolution, fueled by the proliferation of paper currency and the rapid expansion of the banking sector itself. In a mere 5 years, the number of commercial banks exploded from just 4 to 18. When the Democratic Republicans seized the reins of power in 1801, there was an expectation of change, perhaps even dismantling of the national bank. However, the moderates within the party, less concerned with the principles of sound money than their old Republican counterparts, allowed the bank to continue its operations without interruption for its full 20-year charter. This period saw an unprecedented growth in the banking sector, with the number of banks swelling to 117 by 1811. But 1811 brought a dramatic turn. As the bank's charter came up for renewal, the decision hung by a thread, culminating in a nail-biting vote. The fate of the first bank of the United States was sealed not by a landslide, but by a single vote, with Vice President George Clinton casting the decisive blow against the renewal. This moment wasn't just the end of a bank, it was a pivotal juncture in the ongoing debate over financial power and economic policy in America. In the wake of the First National Bank's dissolution, America found itself on the brink of another war with Britain in 1812. Without a central bank, the challenge of war financing fell on the shoulders of state banks. However, New England, still tied economically to Britain through trade, was opposed to the conflict, and their banks, cautious in their lending, were not the financial backbone the government hoped for. In a strategic pivot, the federal government, desperate for war materials from New England, spurred the creation of new banks across the Mid-Atlantic, South, and West. These banks were anything but cautious, issuing loans with abandon. The government then used these newly minted banknotes, often from banks with questionable financial stability, to procure war supplies from New England. The plot thickened when New England banks, seeking redemption of these notes in gold and silver, found the issuing banks lacked sufficient specie to back their paper promises. In a dramatic move in August 1814, as these banks teetered on the brink of collapse, the federal government suspended specie payments, allowing banks to operate without the obligation to convert notes to gold and silver. This decision was a turning point, leading to economic turmoil. The suspension led to a stark contrast in economic stability across regions. While New England banks remained relatively solid, the rest of the country saw a drastic inflation of banknotes and deposits, ballooning by 87% from 1811 to 1815, even as the actual gold and silver reserves dwindled. This disparity fueled regional economic disparities, with the number of banks nearly doubling in 4 years. The economic repercussions were profound. Wholesale prices surged by 35% on average, with inflation varying wildly from 28% to 55% across different cities. Imported goods, cut off by the war, saw prices skyrocket by 70%. The suspension of specie payment lingered, not lifting until February 1817, long after peace had returned. This period was a lesson in the perils of unchecked banking practices and the critical role of a stable currency in times of war and peace. The repercussions of the United States fiscal policy were set to echo through the years. From 1814 to 1817, the suspension of specie payments led to a contraction in money supply, sparking the Panic of 1819 and plunging the nation into depression. Amidst this turmoil, President James Madison, initially skeptical of centralized banking, found himself advocating for the return of a national bank, swayed by the necessities of war finance. Murray Rothbard captured this pivotal moment, noting, quote, "Clearly, the nation could not continue indefinitely with the issue of fiat money in the hands of discordant sets of individual banks. There was two ways out of the problem. One was the hard money path, which was advocated by the old Republicans and, for their own purposes, the Federalists. Instead, the Democratic-Republican establishment in 1816 turned to the old Federalist path, a new central bank, a second bank of the United States." End quote. Madison, despite his earlier opposition to the first national bank, supported the second bank of the United States in 1816, a decision driven by wartime exigencies. Yet, a peace treaty with Great Britain brought a change of heart for Madison, though not for long. By April 1816, Madison signed the bank bill into law, ushering in the second bank of the United States. The key players: Treasury Secretary Alexander Dallas and Philadelphia's own Stephen Girard, the largest shareholder of the First National Bank. Their influence was palpable as they maneuvered their friend, William Jones, into the presidency of the Second Bank, which opened its doors in Philadelphia in January 1817. This bank was eerily similar to its predecessor, a private corporation with a fifth of its stock owned by the federal government, issuing a national currency, handling public debt, and managing treasury funds. Its notes and deposits, redeemable in specie, were quasi-legal tender, but controversy brewed over the bank's lending practices. Without oversight, loans were doled out to insiders, teetering the bank on the brink of bankruptcy just 2 years in. Jefferson had warned of this very corruption, fearing the bank would become a tool for political patronage. Ironically, rather than curbing inflation, as might be expected, the second bank colluded with state banks. In a January 1817 deal, they decided to issue $6 million in credit before demanding specie for debts, a move that supported state banks' inflationary practices. This was in direct contradiction to a congressional resolution inspired by hard money advocate Daniel Webster, which aimed to enforce specie-backed payments for taxes. Thus, the saga of the Second Bank of the United States unfolded, not as a beacon of fiscal discipline, but as a complex dance of power, money, and politics. Right from the outset, the Second National Bank was a ticking time bomb. Their lax approach to capital requirements meant they never managed to secure the $7 million in specie they were supposed to. By July 1818, the bank was sitting on just $2.36 million in specie, while their notes and deposits ballooned to $21.8 million, flooding the market with money and setting the stage for disaster. But the real scandal? Outright fraud. A staggering 3/5 of all loans were funneled through just two branches, Philadelphia and Baltimore, suggesting some shady backroom deals. Their dream of a unified national currency? A fiasco. The western and southern branches turned into inflation machines, pumping out credit and banknotes like there was no tomorrow. They then offload these inflated notes on the more conservative branches in New York and Boston, forcing these banks to pay out their specie reserves. It was a clever, if not corrupt, system where reckless banks could inflate away while the prudent ones bled gold and silver. In essence, the Second National Bank wasn't just mismanaged, it was a masterclass in how not to run a central bank, stripping conservative banks of their hard assets while letting the risky ones play fast and loose with the nation's currency. Less than 2 years after its grand opening, the Second Bank of the United States was on the brink of collapse. The next year was a frantic scramble, as the bank was forced to pull back on loans and credit, especially in the West and the South. By contracting the nation's money supply, it plunged the country into a deep depression. This was the first time America experienced what we now recognize as the classic boom-bust cycle, courtesy of the national bank's volatile policies. In just 1 year, from June 1818 to June 1819, the bank's notes and deposits slashed from $21.9 million to 11.5 million, a staggering 50% reduction. The broader money supply, it crashed from 103.5 million to 74.2 million. Imagine the fallout. Banks failed like dominoes. Real estate values tanked, public land sales dried up, and export prices took a nosedive. Prices across the board plummeted. The drastic measures saved the second bank, but at what cost? As economist and historian William Gouge so poignantly remarked, the bank was saved and the people were ruined. The nation paid the price for the bank's survival, marking a dark chapter in America's economic history. The depression following the Panic of 1819 lingered, casting long shadows over the nation. But from the ashes of this economic turmoil, the Jacksonian movement was born. Spearheaded by Andrew Jackson, the future 7th President of the United States, this was a crusade for hard money, a war against the fractional reserve banking system, and a direct assault on the second bank of the United States. By his side, Jackson had formidable allies like Senator Thomas Hart Benton of Missouri, and his protege, the future President James K. Polk. The battle Jackson was about to engage in would be the fight of his life. But if there was ever a man for such a battle, it was Old Hickory. Stay tuned for our next episode, where we delve into the epic showdown between Andrew Jackson and the banking behemoth. Also, we'll explore the Civil War and their banking policies, and journey through the banking period between the Civil War and the Federal Reserve that G. Edward Griffin refers to as the, quote, halfway house, quote. If you found this dive into history enlightening, make sure to hit that like button, and don't forget to subscribe for more tales of power, money, and the making of modern America.